Hello, everybody, and welcome back. Drastic interest rate hikes by major central banks have changed the environment for real estate investments. Today, we talk to Guy Barnard, co-head of Global Property Equities and a portfolio manager at Janus Henderson, about real estate as an asset class in turbulent times. A warm welcome to Guy.
Thank you, Thomas. Thanks for having me.
Guy, rapidly rising interest rates over the past 2 years have wiped out the calculations of many real estate investors. So how have the rapid increases in interest rates affected the attractiveness of global real estate markets?
Yeah, look, I think it's been clearly a very dramatic and I guess more substantial shift in interest rates and bond yields over the last 12 to 18 months than many of us expected. And it's been a pretty consistent increase in rates around the world, moving from low or negative rates in Europe up into positive rates, and from rates of 1% and 2% in the US up to 4 or 5% today. And that's clearly impacted many asset classes, and real estate has not been immune from that. So the short answer to your question, Thomas, is that we've seen a repricing in underlying real estate markets around the world. We've seen values falling. And in our view, we think values have fallen, broadly for the commercial real estate sector, somewhere between 10 and 20% over the last 12 to 18 months. And that has been driven by the yield requirement of investors adjusting so that they still get a risk premium above and beyond what they can get on government bonds around the world. But I think the point I would also make is a very important one, which is that operationally, so in terms of the income generation and the rental growth that we've seen from the companies in which we invest, things have actually been pretty good. So generally, there is a resilience to the income stream, and that income stream is growing. But clearly, the cap rate or the yield effect has really driven that negative repricing of assets I spoke to.
You recently wrote that listed real estate investment trusts, REITs, performed better than their private counterparts in the 2010s. So what were the reasons?
Yeah, look, I think it's really important to step back and remind people what it is, myself and the team are doing day to day. We are investing purely in liquid real estate securities, so REITs and other non-REIT property companies around the world. Those shares are priced every day by the stock market in the same way, any of the major listed companies would be. And therefore, we react very quickly to changing circumstance. And, clearly the changing circumstance in the last 18 months has been largely around sort of interest rates and bond yields. And so the listed market reacts first. We saw a very heavy sell-off in global real estate stocks in 2022. They were down 25%. Whereas private real estate valuers tend to move slowly. They tend to smooth valuation, gains and losses over a longer period of time based on backward-looking transaction evidence. That is what we're seeing today in public versus private markets. And it's also what we saw in the GFC and coming out of the GFC, where we had taken our pain early on in sort of 2007 and 8 in the public markets, whereas private real estate values were still correcting in sort of 2009 and to some extent in 2010. So we had a valuation advantage in terms of just starting from a better place. And I think the second piece, and this is sort of really important looking forwards as well, is that public REITs found themselves in a situation where they had access to equity and debt capital at a time when, coming out of the GFC, many people didn't have access to borrowing. So that gave them the ability to buy assets accretively. And they also just owned more interesting real estate. So I think as an investor in real estate, you need to ask yourself the question as to what is the underlying asset that I'm getting exposure to. And in the public markets, we have got more exposure to faster growing parts of the real estate market, that structurally are more supported in terms of long-term rental growth. So it's really around valuation, it's around access to capital, and it's around the types and the growth potential of the underlying assets.
So you already touched the next question. So you state that high quality property always ends up in the hands of those who have the best access to capital. So why do you think REITs have an advantage?
I think we're in a very similar situation today that we were sort of coming out of the GFC to some extent. It's going to be a market of winners and losers. And, what we saw in the last 5 years is the people that were generally winning real estate assets, i.e. able to buy them, were those that were operating with the highest leverage, because it was quite easy to make money from real estate when you bought an office building in Frankfurt at 4 or 5% and financed it at 1 or 2%. You felt quite clever because you had a positive carry, and the more leverage you put on, the higher that sort of return on equity became. And that was very hard for our companies to compete against, because they are very disciplined in how much leverage they're going to use and the price they are going to pay as long-term owners of assets. Now, roll forward to where we are today, those leverage buyers in the last sort of 5-7 years are going to have some tricky conversations when they have to refinance their 2% loans at 5% or more. And therefore, in many cases, they will have to raise fresh equity or perhaps even sell some assets in order to repay borrowings. And that is then the advantage for our companies, because global REITs today have a loan to value ratio of only around 30%. So relatively lowly levered compared to private markets. They have continued access, particularly in the US, to equity and debt capital. And as a result, in the last 6 months, we've already seen our companies acquiring around $15 billion of new real estate, high quality assets that they wouldn't have been the winning bidder on 12, 24 months ago. And that is going to be great for us as long-term investors, because it's those assets that we think will generate great long-term cash flows and great growth. So it's really about this sort of winners and losers, and understanding that in the listed REIT market, we think, we've got some very high quality companies with strong balance sheets today.
Publicly traded REITs trade at lower valuations than their private counterparts. So what is the reason for this valuation differences?
Yeah, I spoke to it slightly earlier, Thomas. So it's really the valuation differential in terms of how public REITs are valued every day by the stock market. That means, we are driven by macro news flow, changing, economic policy, and also investor sentiment. And, I would say today, investor sentiment towards real estate is very negative. When we look at the Merrill Lynch Fund Manager Survey, global real estate is the least owned part of the equity market. So everyone is very nervous and worried about the impact of rising rates, and that's reflected in positioning. Whereas on the private real estate side, you are marking to a model. The valuers are ascribing a long-term value to that asset, which strips out short-term swings in sentiment. And as I said earlier, tends to smooth the more significant peaks and troughs that we see in public markets. So, it is noisy and volatile sometimes to invest in real estate through the public REITs, but that volatility also creates tremendous opportunity. And I think what we have tried to communicate to our investors and clients is that we think we're getting towards an opportunity, or frankly, we think we're there already, where public real estate is much cheaper than private real estate. And yet, in terms of, access to capital, quality of assets, as I spoke to earlier, has some long-term drivers that we think will generate outperformance of those public markets.
COVID-19 has led to a changed world of work. Many more people now work from home. To what extent has this impacted the office property market?
I think the office market is making headlines around the world over the last sort of 6 to 9 months. And I think the poster child for the challenges in the office market is really what's happening in the US. So if you look at a market like San Francisco today, we think the vacancy rate in the office part of that city is around 30% when you include space being subleased. So if you are a landlord in that market, you have no pricing power, because you are just trying to hang on to your tenant and protect your income. And therefore, values will need to come down. More leveraged owners of those assets are getting in trouble. And that is why, it is making the headlines I spoke to earlier. Again, the good news for us on the public REIT side is that US office is a very small part of our universe. It's only around 4% of a US REIT benchmark, and it's something that we as active managers have been able to ignore. So it is a challenge. We're not hiding from that. More people working from home, less days in the office, less space overall. And the space people are looking for is going to be in fewer and fewer very high quality, sustainable buildings. So new or refurbished assets that are emitting less carbon dioxide into the atmosphere. So, I think there's going to be, again, winners and losers. The US office market is to us very challenged. But when you look in Europe, it is different. In the West End of London, where I'm based, vacancy rates are only 2 or 3%. The same is true in the centre of Paris, and rents are going up for the best quality space. So, Europe is not the US, particularly in those more centrally located districts. But again, we have to be very, very selective in where we have our exposure in the office market today, because structurally, there is going to be less demand for space, and that means, lower rents on average in many markets.
The interest rate gap is widening globally, for example, between industrialized countries and emerging markets. So to what extent has this changed the attractiveness of individual regional real estate markets?
Yeah, so we run global funds at Janus Henderson. So we've got exposure across the world. I think, interest rate rises, as I said earlier, have been sort of pretty consistent in most developed markets in terms of the magnitude of increased. You've just started from different levels, and that is affecting, as I said earlier, the pricing of real estate in those markets. But there are a few outliers, and I would say the ones that spring to mind for me are Japan, where clearly we have a very different monetary policy, a 10-year Japanese government bond of 0.7% today, very different from the US at 4.8%. And our team have been in that market recently, and what you're seeing is actually property prices have not corrected very significantly. They've been much more stable, and there is still good transactional evidence to support a more modest pricing correction in Japan. In Europe, you would look to Switzerland, where again lower interest rates, inflation more under control, and therefore the magnitude of price decreases has been lower. And then on the other end of the spectrum, sort of Hong Kong is a very challenged market at the moment. In Hong Kong, you have the combination of US monetary policy, so US interest rates, and China growth. Interest rates are high, growth is slowing and quite challenged, and therefore that is a market that is going through a fairly difficult adjustment at the moment.
So you already mentioned some of the interesting markets like Japan or Switzerland. What potential opportunities and risks do you see for the global real estate market in the next 12 months? And beside the interest rate level, what are the decisive factors?
Yeah, look, I spoke to a sort of price correction taking place in real estate markets, and that's frankly quite healthy when interest rates move as they have done, and we need to get through that. But I also spoke to the importance of income and the fact that many of our companies and many underlying real estate assets have continued to deliver dependable and growing income streams. And I think that is really the focus for us, particularly if we do go into, a slowing economy or, perhaps a recession in many markets. And that to us means you've got to be very careful and selective in which types of property you get exposure to. So we want to find underlying real estate assets that are supported by structural drivers of demand from their tenants that will offset a slowing economy. So areas that we like would include areas like industrial and logistics real estate assets. So the big distribution warehouses used by the likes of Amazon to get our goods to us in 12, 24 hours and adjust to that sort of new digital e-commerce lifestyle that we have. Other areas would be technology-focused real estate, so data centers, which are going to benefit from AI adoption and more demand over time. Cell towers, again, very recession-resilient income streams. And then alternative parts of the market like student accommodation, single-family housing rental, where there is a chronic undersupply. So, The opportunity for us is really coming by finding those high quality real estate assets run by good management teams with strong balance sheets, where we think we are going to see dependable and growing cash flow streams and dividend yields. And that is going to look more and more attractive if we do get a slowing economy.
That was Guy Barnard from Janus Henderson. Thank you very much, Guy, for the interview and for sharing your insights with us.
Thank you.